As part of the tax reform proposals, the basic exclusion amount for gift and estate taxes will be reduced by one half. However, that automatically also applies to the generation skipping transfer tax exemption, which will get a similar reduction. So because of that, the GST tax could become a bigger concern, and practitioners should be aware of how it applies. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 239, we're going to dive into some of the broader points of who pays when it comes to the generation skipping transfer tax. Now, I've covered a lot of material in the past on how this tax applies, when we have exempt trusts, and so on and so forth. So part of this discussion today will be kind of a refresher on some of those topics I've talked about in the past, and allows me to brush up on my skills of refining that into a cohesive narrative. And then the other part we'll dive into towards the end is who actually pays and reports the GST tax. Now, as always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. A little bit about me. I do what I do because I enjoy speaking and teaching. So, if you love this presentation or any other content I've put out, and you'd like to engage me as a speaker for your upcoming event or for an in-house type of program for your firm or organization, you can reach me at griffin.bridgers@gmail.com. And if you'd like to receive this and other more exclusive content, you can subscribe to my newsletter at griffinbridgers.substack.com. Now, jumping back into the topic of GST tax, we're really going to do a refresher in these first couple of slides on what I've talked about in the past. Now, a generation skipping transfer tax, or GST tax, is imposed in addition to gift or estate tax on transfers to a skip person. So a skip person is anybody who's 2 or more generations younger than the transferor, so long as the descendant ancestors of the skip person are living. And if they're not related to the transferor's grandparents, then it's simply any recipient of a gift or inheritance who's more than 37 and a half years younger than the transferor. So the GST tax rate is a flat 40%, but this rate can be reduced by multiplying it times an inclusion ratio. So to understand the inclusion ratio, you must also understand that there is a GST tax exemption that's equal to whatever the estate and gift tax basic exclusion amount might be. Currently, that's $11.7 million. How that factors into the inclusion ratio is that the inclusion ratio is 1 minus a fraction, the numerator of which is the amount of the GST exemption automatically or manually allocated to a transfer, and the denominator of which is the fair market value of the transfer. So, with the inclusion ratio is 1 or an amount less than 1. So it's 1 if there's no GST exemption allocated, and it's 0 if enough exemption is allocated dollar for dollar to the transfer that's in question. So, in other words, a better way to think of this is that if enough GST is allocated dollar for dollar to any transfer that goes to or may ultimately benefit a skip person, what that creates is a 0 inclusion ratio. And when you multiply 0 times the 40% GST tax rate, you get a 0% GST tax. So an example here numerically or mathematically is 40% times an inclusion ratio, which is 1 minus the fraction representing the GST exemption in proportion to the actual dollar value of the transfer. So if you allocate GST exemption dollar for dollar, you essentially have a 1 over 1 fraction, and your inclusion ratio is 1 minus 1 over 1, or 0, which when multiplied times the 40% rate gives you a 0% rate. So a good way to think of this is that your inclusion ratio is always going to be somewhere between 0 and 1. And your rate is always going to be somewhere between 0 and 40%, depending on what that inclusion ratio might be. Now, in addition to that $11.7 million GST tax exemption, which is allocated concurrent with the application of the gift or estate tax, there are some other exclusions that can apply at the time of the transfer or down the road, as we'll see. One is a GST tax annual exclusion of $15,000 per skip person, but it has some different rules I've talked about in the past. In other words, crummy rights don't work the same with those types of transfers. Then also any direct payment of medical expenses and tuition while exempt from the gift tax is also exempt from the GST tax. The difference is the GST tax on that type of payment could be deferred until some point in the future, as we'll see. Now, a lot of times when you see this apply, is we're going to see it's going to apply in the context of trusts, especially in the deferral of GST tax to a later date. So it's important to note that before you really dive into this, you have to know that certain trusts are grandfathered to the extent that they were irrevocable on or before September 25th of 1985. And so long as nothing's been done to change the grandfathered status, then there's never any GST tax that can apply to the assets within that trust. But things can change, for example, if there's been an actual or constructive addition to the trust since then, or if at any point the trust assets have been subject to gift or estate tax in the hands of another person. Now, with that being said, when is the GST tax assessed? You have either an immediate application of the GST tax or a subsequent determination of the GST tax at some point down the road. But either way, whenever a transfer takes place that is subject to gift or estate tax, what there is there's always an immediate application potentially of the GST tax exemption, which is going to determine either the immediate or later GST tax liability. So if the transfer immediately benefits only skip persons, then this is known as a direct skip, and there's an immediate GST tax liability that applies in addition to the gift or estate tax that might apply. So if the GST exemption has been used up and there is no other exclusion, then in that case the transferor, who's either the donor of the gift or the estate of the decedent, has to pay GST tax out of pocket. Now, it's important to note that in that type of case, any GST tax that's paid by the donor or estate will increase the amount of the transfer so that the gift or estate tax is assessed on the combined total of the amount being transferred and the GST tax being paid. Now, what is more often the case is that the transfer may benefit skip persons in the future. That might be the case if you have, say, a trust, which has non-skip persons as beneficiaries and may have living or future-born skip persons as beneficiaries as well. In that case, you have to wait until some event occurs in the future which keeps non-skip persons from ever benefiting from a portion of those assets again. Now, what we have here is what's known as an indirect skip, which essentially defers GST tax. So to understand who pays in the case of an indirect skip, it's a timing question. So what we have here are two events that can occur which determine the amount being transferred to a skip person. One is a distribution to a skip person, which is called a taxable distribution. And the other is a situation where the interests of all non-skip persons terminate, either by death or by passage of time. And that's called a taxable termination. In either of those cases, you now know the exact dollar amount that's going to or for the benefit of one or more skip persons, so at that point, the GST tax can be applied. So, in terms of the tax payment and tax reporting, there's different treatment for a taxable distribution or a taxable termination. In the case of a taxable distribution, the skip person who receives it is liable for payment of tax, the GST tax, from that distributed amount. And it has to be reported on IRS Form 706 GS(D), which is due by April 15th of the year following the year of the taxable distribution. On the other hand, with a taxable termination, instead of the skip person or persons paying the tax, you now have the trustee of the trust who's responsible for withholding and paying that GST tax and reporting it on IRS Form 706 GS(T), which is also due by April 15th of the following year. So having looked at who pays and who reports, which is the same person, you have to really kind of look at some of the catches that come into play when you're analyzing this when we have indirect skips. Now, indirect skips may not be taxable in the form of a distribution or termination until many years have passed, at which point the original transferor may be deceased, which is why we have a trustee or skip person paying this GST tax to the extent there is tax. Now, it's important to note that if there is that perfect one-to-one allocation of GST exemption up front and nothing's been done to change that GST exemption at any point, that means there's a zero inclusion ratio, and that means that the GST tax on the distribution or termination will be 0%, regardless of how big the trust or distribution may be at the time. So in that case, there's no tax to pay, there's nothing to report, you can go on your merry way. We're more concerned in a situation where the inclusion ratio is greater than 0. And before you even get to that, it's important to check to see if the trust is grandfathered. It's also important to note that a distribution may be a direct payment of medical expenses or tuition on behalf of a skip person, and in that case, no matter what, that's not a taxable distribution in any amount. So that's a good idea where you can have, for example, a GST non-exempt trust, because that's a way you can use those assets to benefit skip persons without the payment of GST tax. Now, with that being said, that perfect one-to-one allocation of GST exemption means that trust can grow to an infinite amount without incurring GST tax down the road on a distribution or termination. But the problem is there's a lot of homework involved to get to this point where we can determine the GST exempt status of a non-grandfathered trust. So essentially you have to go back to check all contributions to the trust at the time they occurred to determine whether there was GST exemption allocated automatically or manually at the time of that contribution. Now, there are generous automatic allocation regulations which can save your butt, but it's important to note that the regulations in their current form didn't apply to indirect skips until January 1 of 2001. So any transfers that occurred prior to that date could mess things up, and you may have to go back and manually check those to see if there was allocation of GST exemption. And usually that would happen on a gift tax return or on an estate tax return. But gift tax returns may not be complete and may not highlight this, especially in situations where additions to irrevocable trusts did not require a gift tax return to be filed. And that would often be the case for things like annual exclusion gifts that have crummy powers, because even though there's no gift tax, you do have to automatically or manually allocate GST exemption at the time of those types of transfers in most cases. So the trust records, especially accounts that show transfers, will become your best resource, and there's a lot of homework here to be done by the trustee to, one, determine if there's a GST tax liability on any subsequent taxable termination, and two, to properly inform beneficiaries who are skip persons if there could be GST tax liability on a taxable distribution to them. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Please note I cannot give tax or legal advice in response to your questions. But thank you again for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.